Hello, everyone, and welcome to Jane's November review for 2023. Sorry the video is taking a little bit longer. I often run into this issue, it seems like, but my son Sawyer's normally been fussy from about 9 to midnight, which is my normal time that I do these things, and fortunately tonight he's been extremely happy. Hopefully it's the turn of a new page, and let's go ahead and dig into the numbers and take a look and see what we have. So as always, I'm not a financial advisor. I don't claim to be one. Article reflects my own views and does not reflect that of my employer. And then I do share a number of positions in similarity with Jane, and I have those listed on the screen. And then in this portfolio, these are actual shares being traded. This is not a play money portfolio or a fake portfolio with fake shares. I try to include as many screenshots as I can to validate that. And then the why I do this, I was going to add kind of an additional thing to this that, one of the concerns that John and Jane would talk about a lot is that they knew that they had a lump of money or a sum of money, but they weren't necessarily sure as to how that was going to sustain them in retirement. And so one of the things that I talk to them about a lot is that, rather than the 4% rule, which is just to say draw 4% of whatever you have in your account and that's what you live on, and then that should sustain you. I wanted to change the conversation to, instead of drawing it based on the amount that's outstanding in your account, the balance, which is going to fluctuate no matter how secure your investments are, there's going to be some level of fluctuation. And even if you go with really safe investments, it's still going to fluctuate in the sense that if you draw 4% of your balance down, you're not going to have the potential of the balances to increase if you're going with things that are extremely safe and not going to lose or gain in value. So, point being that my discussion with them was to change the way that they think about their retirement and say, okay, what is my goal in retirement? My goal in retirement is income. Okay, so is the best way to achieve income just to draw balances out of my account? Or would it be to own assets that produce income? So in a way, part of what we were really doing here, and this is a kind of a loose way that I explain it, is that we created what is effectively a pension-like effect with their income, right? Everyone that has pensions love pensions, and the reason why they love pensions is because they go, it's guaranteed. I'm actually not a big fan of pensions, and the reason why is because, yeah, they can tell you that the money's guaranteed, but what happens when, someone else that's managing it makes bad decisions or something like that? You have no control over that. And also pensions, it tends to favor the people who are on the beginning end of the pension, rather than the people that are following up and now paying in. So it's kind of one of those things that unfortunately, like Social Security is the best example of one, where you're writing checks that you can't cash, or at least my parents will benefit from Social Security. John and Jane will benefit from Social Security, but I'm not probably going to benefit from Social Security at all. I'm just going to have to pay into it for the rest of my life. So anyway, again, just changing the way to think about retirement. So that income is something that we can create so that we're no longer focusing on drawing down balances. We're focused on owning assets that generate that income and also provide increases to that income. So as far as the background goes, both of them collect Social Security, and Jane isn't drawing anything out of her account yet, but they do draw $1,700 a month out of their taxable portfolio and then $1,000 a month from John's traditional IRA. They do own other investments outside of what I help them with, and those are going to be primarily certificates and other low risk investments. And then they have no debt or monthly payments other than basic recurring bills. So they make everything very simple for me in terms of helping them, because they live a very simple lifestyle. So that gives us the maximum amount of flexibility to draw money or not draw money. And that ultimately means that I can typically invest more back in, and help them with that, rather than them drawing money out and then potentially trying to purchase assets that have higher yields to compensate, because those assets that tend to have higher yields tend to come with more risk. So as far as the headlines go, the traditional IRA generated just over 1,400 in November of 2023, and that compares with 1,227 in November of 2022. And then the Roth IRA generated just over 850, and that compares with 766 in November of 2022. So we saw modest increases in both of those. The traditional IRA had a balance of just under 430,000, and it was also just under 430,000 in November of 2022. So we're basically flat across the board. And then the Roth IRA had a balance of 203,000, and that compares with 204,000 November of 2022. So no surprise there. We saw basically that they are flat in their balances year over year, when it comes to their accounts. So, or when it comes to Jane's account. There were 3 companies in her retirement portfolio that paid an increased dividend or a special dividend in November, and no companies decreased their payouts. So we already covered Verizon in the taxable account review, and that was a 1.9% increase. Agree Realty was a 2.9% increase, and then Concentrix was a 10% increase. So for Verizon, I like to include the gain-loss tables that show, like right now, Verizon's currently sitting underwater in her account, and in some ones, or at least a very small number of shares, it's very underwater. But most of the shares are owned in about the mid $40-ish a share range, mid to upper $40 share range. So as far as her account goes, since February of 2020, she's collected about $1,650 of dividends from Verizon. And I just wanted to note that, Verizon, if it moves back under $35 a share, then I would consider adding more into her portfolio. But at this point in time, it's not attractive enough yet, especially with what looks like rates potentially decreasing. Agree Realty, so this is a newer holding in Jane's portfolio, and since January of 2021, it has generated $1,370 of dividends. And one thing to note is that you'll see that the holdings go back to late 2020, but the bulk of the holdings, or at least the amount of the holdings, increased pretty substantially in 2022 and then again in 2023. Same thing with Verizon, currently sitting underwater, but not nearly as much as what it was with Verizon. Kind of obviously hindsight's 2020, makes us wish that we could have purchased some in the $50 share range, so we could have ended up selling off some of the ones that the higher cost shares that we do have now. But hindsight's 2020, and that's just the way it's got to be. But we did, in fact, previously have more shares of Agree Realty that was in the $70 a share range, and those have been sold off, and they were sold off due to the fact that they were the high-cost shares. For Concentrix, definitely not a big dividend payer. It is a tech company, and it was the spin-off from SNX back in November of 2021. And shares of SNX were originally bought during the lows of COVID, and so that's part of the reason why we have such an awesome cost basis when it comes to Concentrix. But the value of the stock is about the same as the time it was spun off. So there's concerns about its growth. But it has been giving some pretty reasonable dividend increases, and frankly, based on the earnings that it has, even if earnings are slowing, I still think that it's at least an interesting enough holding and a small enough holding to warrant keeping at this point in time. And for the November trades on the traditional IRA, EOG, we originally sold the high cost shares. Part of this was due to seeing that there's falling energy prices, but also because it's not a core holding, and so we're okay with letting go of some of the higher cost shares in favor of waiting until we get the opportunity to add some on weakness. And then with Enbridge, this was a good example of one where actually in the previous month we bought it in the really low $30 share range, and then we went ahead and added even more, again at $33.61. So this is one of Jane's largest holdings, and the stock price has since moved up considerably. I believe it's above $36 a share, or at least close to it the last time I checked. And then for Avient Corporation, we recently sold some high cost shares in December, so that will be reflected on the next video. But the remaining shares are at an average cost basis in the mid $30 share range. So basically, from buying these extra low cost shares and then selling off some of the high cost shares, Avient has now moved back over the $40 share range. So you could make the argument that we sold too soon, but again, when it comes to John and Jane's portfolio, everything we do errs on the side of caution, and so we'd rather sell it and not make as much money, or not make as much as we could have, I should say, in favor of doing that versus potentially exposing her portfolio to more risk. And then for the Roth IRA, we reduced the high cost holdings of American Tower Corporation. Very similar situation to what happened with Avient Corporation, where you could say that we sold it off too quickly, but again, erring on the side of safety and focusing on reducing the high cost portion of the position in favor of being able to buy lower cost shares if it moves back down again. Always something that I'm in favor of. And then as far as RMP, we've added to RMP a number of times, and that price for that closed-end fund has come up considerably since the purchases that you see on the screen here. And we will look to trim back some of the really high cost shares, but we're going to need to see a significant improvement in price before we would be looking at really trimming it back, because we're probably talking, in the upper, mid $20 share range for the higher cost shares. And then for the November realized gain loss, you can see that the net lease office properties, for some reason it was split up into two trades here. And in this case, we could have made the argument that we could have held on a little bit longer. I think it moved up to close to $20 a share. But really, we weren't interested in doing the research needed to warrant whether or not we held that position or added to that position. So we were content with selling it. This was the spin-off from WP Carey. And then for EOG, you can see here that, a small profit was made on these shares. And again, it was in favor of being able to establish a stronger low-cost position. And then as far as the Roth IRA goes, you can see here where the original sale that we had for American Tower was where we took the loss at. So this was prior to the rally that we had in real estate investment trust prices, and especially with the Fed announcement. And then you can see that, just 12 days later, we went and made a sale, and the share price had moved quite a bit higher, but also the cost basis on those higher cost shares were lower because we had sold off the higher ones here. So and then with PPG, sold it off, what again could be made the argument of a little bit too soon, but we're left with a very low cost basis because in the month of October, we had purchased more shares of PPG. And then for the year to date, when you look at it, something I had pointed out previously that I thought was kind of interesting is that when you look at the portfolio and whether or not it's sitting on a gain loss, and we'll look at those tables in a little bit, this is a screen that with the other table that I'm going to show you about the gain loss can show you that I'm not trying to hide the losses behind the sales, because the thing about the realized gain loss, which is what this is, versus the unrealized gain loss, is that the unrealized gain loss can be made to look better by making the realized gain loss look worse. So you could sell off a bunch of losers, leaving your ones that are winners, making it look like you are the king of trading in a sense. But in this case, what you can see is actually the majority, I mean, the significant majority, 91% of it was sales that were actually gains, which means that when you look at the unrealized gain loss, had we not sold these, that unrealized gain loss would actually have been higher. But if you had a scenario where you were to look at something like this and you saw that the total losses were higher than what the gains were, and then you looked at the unrealized gain loss and saw that it was sitting on a bunch of gains, well, that's because they sold off a bunch of losses to make it look like things are going better. So just know that the difference between the realized gain loss and the unrealized gain loss can be a very significant thing, especially if someone is trying to claim that they are beating the market or that they're doing better. It is possible to hide it behind the information. So in both the traditional and Roths, you see that the gain loss ratio, we sold off some of the winners, and that was mostly to move the money over into CDs or money markets. So that was intentional for selling off some of those gains, so that we could put it into investments that were safer for producing income. And then for the comparison here, we have SWVXX, which is the money market for Charles Schwab, and then CD income represent a huge increase compared to 2022, and then the elimination of AbbVie, and then the large reduction in size of Eaton, East West Bancorp, and General Mills are the other major differences that you can see between those two tables. And then for the November Roth comparison, so we've increased Agree Realty and RNP significantly, no surprise there. But then the shares no longer held funds were from EMRAF, that's America Corporation, that is a utility company in Canada, and there were just some things going on there that made it to where it did not look like it was going to be as promising of an investment. And based on where the share price was, it made sense to sell it and get out of it at that time. And the CD income was just received in the month of November. So that's the first time that we've received CD income in Jane's Roth IRA. And that'll be a pretty large component of the income produced moving forward. And then for the full year-over-year comparison, I really love this table, and the reason why is because we could see that from the previous video, we were estimating a 9.7% increase year-over-year as of the October update. That has since moved up to 10.9%, which is partly explained by how substantial the income increase was, and because I don't count the certificate income and the money market income because of how much it fluctuates, that erring on the side of safety is part of the reason why you see such a large increase when it comes to this. So for the Roth IRA, very similar situation as well. I accidentally, looks like I put 5.6% here, but it's actually 5.5%. But that's up from 4.2% in October. So remember too that when you look at the yellow here, that does not include certificate and money market income due to the fluctuations. So it's possible that we might see these move a little bit or quite a bit more higher. I think it'll tend to be close to about 11% and 6% for the Roth as the final numbers when next month's video is made. And then for the account balances, I'm not going to go over this much because of what I mentioned at the beginning of the videos, or like the fourth slide, where basically you can see that the account balances are basically the same year over year. One thing that I think is worth noting is that all dividends and interest have been collected as cash and either reinvested or left as cash. So the thing is that year over year, that income, had that been drawn out, we would end up having seen a balance that is less than where it currently is, and that's okay, because it doesn't necessarily mean that it performed poorly. It just means that the balances were down, and as you can see here, there's quite a bit of fluctuation. When you look at the average balances in the traditional IRA, year over year, it's within about $500 of each other, and that's actually pretty incredible that that's been the same. And then this is still even being within about $4,000 of each other, using the month-end balances, is pretty impressive. And then for the 6-year review, you can see where it's been a steady increase since basically since inception when it comes to the traditional IRA, and it has been double-digit increases every year. That we've been tracking this for 6 years, so that's a really awesome thing to see. Something I'm super happy about. And then the Roth IRA, quite a bit more fluctuation. Some of this due to having maybe being a little bit more real estate investment trust heavy, but just not seeing as big of increases during like COVID years here, but then this year being at the 5.5%, that's still, in my opinion, a strong increase, especially when we consider that there's no new capital being added to this account. And then for the cash balances, you can see cash balances have basically more or less stayed about the same. Trading activity has slowed down quite a bit, and a lot of that has to do with the fact that the market is reversed, and that means that things aren't as attractive as they were, and that is the big reason why we're going to slow down on adding new shares. The cash balance in the account do not reflect money market or CDs. So if we add those in, which are traditionally considered to be very liquid investments, there's currently about $110,000 in the traditional IRA, and then another $30,000 in the Roth IRA. And that's funds that are in money markets and or CDs. So a total of 140,000 of Jane's portfolio is currently in those types of investments. And then for the unrealized gain loss comparison, as I was mentioning on an earlier slide, that when you look at the loss here, that loss has minimized, and this number would potentially have been higher had we not sold those off. So basically selling off the winners went from being an unrealized gain to being a realized gain. And again, there's nothing wrong with that. It's an important distinction to make, because these unrealized losses are only realized if we sell those shares. And what you don't want to do is see someone claiming that they are sitting on a bunch of unrealized gains, when in fact what they did was they sold off a bunch of shares that were at losses and realized those gains. So trying to make it look as if their portfolio is performing better than it is. And then for the traditional IRA, on the gain loss piece of it, I always consider this to be the most important table. It is currently averaging a yield of about 4.65%. If you remember, I was mentioning the rule of 4%, where you draw off 4% of your balance every year, and that's what you live on. In this case, with the current yield being at 4.65%, Jane could technically draw off 4.65% of the funds, and that would technically be covered entirely by dividend income. So in this case, the fact she isn't drawing anything off right now, we're just collecting those as cash, is definitely going to help give more flexibility. But that's another reason why that rule of 4% versus just looking at how do I create income and how do I draw that income off in favor of having to sell shares in order to generate the funds needed in order to do my investment. It makes it much less complicated, because you don't want to look at this list and go, okay, how do I know when I'm going to sell Broadcom, which is performing extremely well, but I need money to survive, right? Instead, we'll say, okay, well, Broadcom's performing really well. I'll choose to sell it when it makes sense to sell it, but until then, we're going to collect dividends, and even though it's only at about a 2.1% yield, that combined with the other shares that are on here is generating 4.65%, which is plenty for Jane to be able to live on. And then for the Roth IRA, very similar situation. The current yield is about 4.69% on the balance of the account. And so this has been updated. It was on December 15th. But yeah, a very similar situation as what you saw with the traditional IRA. I don't think there's really much more to explain than that. So unless there's questions in the comments, I'll just move on to the next slide. And then, so in the conclusion here, I'm going to shorten this up from what my original shoot was, because I kind of went on a rant. But basically, cash balances have increased substantially with the reduction or elimination of certain positions that don't present a compelling risk reward. The Federal Reserve announced potential interest rate reductions up to 75 basis points in 2024. There's a lot of people that are viewing this optimistically. I'm predicting that we are going to see an employment situation shift, and the industry that's going to be the first to fall, or at least be the first domino, is going to be the auto industry. So part of this is, and this is where I'm going to shorten up my explanation on this, is that manufacturers have produced more cars than what the dealerships can sell right now. And part of that has to do with where interest rates are, but also it has to do with going from having no supply to now having a significant amount of supply. But we're seeing record numbers of repossessions and people unable to make payments on their vehicles because the price of these vehicles, of what these manufacturers are churning out, doesn't make sense for the average person to be going out and buying a $75,000-$80,000, basic SUV. Not even, what used to be like a Porsche, is now just basically, your normal SUV, soccer mom SUV kind of thing. But basically, if the dealers can't take the vehicles, then the manufacturer's job is to come up with incentives. And if you guys pay attention to the advertisements, yes, we're in winter, and so there tends to be a lot of incentives in winter anyway. But taking it a step further, you now see everyone doing it, even Toyota trying to make things more attractive. We have a Subaru lot that is typically known for having, the least number of days of inventory in the system, meaning that Subarus, there's just not a lot of them around, and their lot has been completely full. And clearly slowing down on the sales. So if Subarus aren't selling, if Toyotas aren't selling, if Hondas aren't selling, that's when you know that there's something going on. So if the manufacturers can't get the incentives, up that make people want to buy these vehicles, that's when you're going to have to see job cuts. And especially with the union having negotiated significant pay increases, that now represents a huge liability for these manufacturers. And if that happens where they have to cut those jobs, then you know that their orders from suppliers are also going to get cut. And so it tends to have this ripple effect through the economy that if the manufacturers aren't making cars, it's going to affect a lot of industries, a lot of suppliers, a lot of transportation. It's autos have a huge impact. And the last point I'll make is that, in 2008, everyone remembers that it was a real estate, mortgage crisis. But I was talking to a coworker that was like, wow, I didn't even realize that there was an auto crisis. That GM had to be bailed out, that Dodge had to be bailed out, that it was pretty brutal and ugly. And so that's the thing, is that in this case, I don't think we're going to see the same kind of thing with mortgages, because mortgages have they have higher standards as far as proving income and ability to repay, but also you have the reinsurance products from Fannie and Freddie to make sure that the financial institutions don't take massive losses that they can't afford to. And when it comes to autos, though, there's none of that. It wouldn't surprise me that if it's bad enough that the government comes down and says, okay, we're going to start implementing standards that need to be followed in order for people to get qualified for auto loans. So rant over, but something to be aware of, and something that I find to be really potentially concerning. So, yeah, I won't reiterate any of these other parts. I think that we've already discussed them. It's just the only last thing I guess I'll say is that we've moved quite a bit of money into the Schwab money market, because the buying opportunities have really dried up. There's just really not much that's now undervalued, that's worth buying into, because everything has gone from being at an attractive value to now being, more fully valued. So anyway, thanks everyone for watching the video. Would love to see some comments. Thanks to those that have thrown some comments in there. Anything to help with the YouTube algorithm is greatly appreciated, and I look forward to hearing from those that have watched in the future. Thanks again.